if you change your investment strategy based on your personal circumstances changing, it will improve your ability to achieve your goals. Hey, this is Chris, and I'm going to be answering a common client question in this video, which is, should I change my strategy when markets fall or are volatile, or will Stockspot change my asset allocation based on market movements? And there's two separate questions there, so I'm going to answer the first one first, which is, should I change my strategy when markets are volatile? And our answer to clients is, there are good reasons and bad reasons for changing your investment strategy. A bad reason for changing your investment strategy is if markets are up and down and you're trying to time getting in and out of the market at the right time. We wouldn't encourage that, because markets are always volatile, and what you should always expect when you invest is that markets have periods of going up and down. And ultimately, you should have been put in an investment strategy that was appropriate for your capacity and tolerance for those ups and downs in the first place. So you should be able to ride out those ups and downs and still achieve your goal based on however long you were planning to invest for. So if the market's volatile, that's not a good reason for changing strategy, because what we typically see is people will change to a more conservative strategy after markets have fallen, and then they miss out on the returns that come after that. Or they'll see markets rise and they'll move into a more aggressive strategy after markets rise because they want to earn those higher returns, but that's often not the best time to be doing that as well. So don't use markets as a reason for changing your investment strategy. However, there are some good reasons to change your investment strategy. That is if your circumstances have changed. So we send out an annual risk review or an annual review to all clients every year, where we ask them to recomplete those questions that help us understand your time horizon, your capacity to take risk, your cash flow needs, and all of these answers help us determine whether you're in the right strategy for your personal circumstances. And absolutely, there are times where your personal circumstances change, where your time horizon might be shorter or longer, or you might have more propensity to take risk or less. And these are great reasons to change your investment strategy, because if you change your investment strategy based on your personal circumstances changing, it will improve your ability to achieve your goals. So there's a good reason and a bad reason for changing your strategy. The second part of the question was, will Stockspot change my asset allocations based on market conditions? Now, we don't change the asset allocations of our portfolios to try and time markets. We have no idea whether markets are going up or down next week or next month, and our view is that no other professionals do either. And so we try and set everyone up with the right long-term strategy for the start, and we try not to make too many tweaks along the way. The one time where we will do some changes to your portfolio is where markets have big gyrations. So if markets have a big rise, we might be selling some of those assets and investing into assets that haven't done as well. And if markets have a big fall, we might be selling some investments that have done well and buying those ones that have fallen. And this is called rebalancing, which actually helps to make sure that the risk within your portfolio stays pretty steady over time, so that your risk tolerance matches up to the actual risk within your portfolio. So while it's not a change of your strategy, what it does is just helps to make sure your strategy itself stays pretty level over time, and so you don't end up taking too much risk or not enough risk to achieve your goals. So yes, occasionally we do make changes, but it's not in reaction to markets. We're not trying to guess where the markets are going up or down. And actually, usually, we'll be selling investments that have been doing well and reinvesting that into assets that haven't done as well, because that's what helps to keep your portfolio balanced over the long run.